So thank you very much for your time.
Pleasure.
My first question is as a matter of investing. So if I'm an investor and I have a portfolio with 60-40 equities and bonds, or if I have some asset classes, anti-fragile and fragile, where do I put your way of investing the AI investment?
Well, as I was saying during the introduction of this short seminar, the thing is not about where to invest, but how to invest. Okay, and the AI thing, I really don't like the AI is like algorithmic investment, using algorithms, using math, basically is about providing objectivity to your investments, whatever your risk profile is, whatever the asset class you're looking at. So it's about being able to make decisions with objectivity. Okay, and that can only be done through algorithms, math, however you want to call it. Now, so once you have you may have a risk profile, you have appetite to be, I don't want to be in Asian markets, I want to be US plus Europe, I'm more bonds oriented now, but then you have to build a portfolio and you have to manage that portfolio constantly. There is where quant or math can come to do it in a disciplined, objective way. Am I saying this is always better than a buy and hold strategy? No. I'm saying that it is probably safer from a risk point of view.
Why is it safer?
Because there is the main argument typically for a buy and hold is look at the S&P, the average return per year is close to 9%, so it's better to buy and hold. And from a very simple mathematical point of view, that is truth. You take and you calculate the average return over the last 100 years, it's 8 to 9%. Fine. But nobody talks about standard deviation, which is risk, deviation from the average. Let's not talk about the S&P. Let's talk about the Nikkei, which is now rallying very strong, right? The Nikkei reached a high back in 1990, exactly. I'm talking about 35 years ago. And it is still below that high. The Hang Seng, China, today is very popular because it has been rallying for the last months, but nobody should forget that it went 55% down 1.5 years before. Okay, so the markets have deep drawdowns, deep retracements. If you are not lucky to buy with the right timing and you buy in the highs, it will take a lot of time to recover. Now, there are techniques to solve or to reduce that risk, which is buy regularly, even if the market goes down. But that is very difficult to be done for a human. It has to be automated. Otherwise, if the market is crashing down, you stop buying. No, you should keep buying, but nobody buys. You don't want to be the last one.
Yeah. But do you use AI as a marketing instrument? Because hedge fund industry tries to minimize drawdown since more than 50 years, and investing with algorithm is older too.
It's very old, yes.
So did you try to use a fashion word to market? To market, yeah.
I try to avoid it. If you see the title of our conference, it didn't say AI, it say quant intelligence. And remember one of the first slides by Sarah said in the history there were quants, then there were data scientists, now there's AI specialists. I consider myself a quant. Mm-hmm. I'm an engineer. So it's about algorithms, it's about crunching data. AI has been there for a long time. AI tools, when I talk about AI tools, I mean neural networks, machine learning algorithms, the tools that are being used today, I already started using them in the 90s. There was less data, less computation power, but the tools were there. Okay, so that is not the important thing. I will say, look, the important thing an algorithm, an AI algorithm, is like a violin. If you don't know how to play the violin, it's useless for you. Violin, yeah, you have to. So what do you need to make AI work? The algorithms work. You need to understand the markets. You must have intuitions, ideas, and you should be able to test them, back test them properly. Okay.
But does it work on every market? I mean, on commodities, FX, equities, emerging, and so on. Where does it work better?
It depends on what you are looking for. Okay. So the markets are they have become, at least compared to what I lived in the beginning when I started in this business. When I started, there were equities, bonds, some futures, but there were no ETFs. The markets were very narrow. So now they have been enormously complex. Why? There are a huge amount of opportunities. They are much more liquid. So where does it work better? I don't have an answer. I think it works as long as you are able to find a combination of algorithms that provides the value you are looking for. You may be looking for a type of value like a long-short strategy. We want to be market neutral or beta neutral. Well, that is a challenge. Or the other challenge is I would like to act like a sniper, like that's trading from the past, which is I want to extract value from short-term patterns, but I want to minimize the time I'm invested. Totally different strategies, totally different targets. One, long short, we always invest long plus short. It has nothing to do as a strategy with the trading from the past. Totally different. So you think, where does it work better? I don't have an answer. The idea is there are a huge amount of opportunities. You have to have an investment idea. What am I looking for from investment? And can I apply math to do it better systematically? I think that is my opinion.
But there are many quant funds at the moment.
There are,
so
yes.
Maybe it's only 3 or 5% from the industry. But where is your alpha? Where generated in the quality of the data, in the algorithm, in the speed to have the data?
No. Our advantage is the quality of the data, the quality of what we call augmented data, which is how we transform raw data into data that can be analyzed by algorithms, which is totally different. An algorithm can't extract value from a balance sheet. The balance sheet has to be transformed into numbers that are normalized so that can be compared across companies, sectors, etc. So our value is in high quality data, being original, creative in augmented the data, so creating that data which is suitable for algorithms, and then having intuitions about where to search. And this is very human. This is not artificial. This is very human. Intuition is trained from the past is a good example. It is the result of an intuition. The intuition is that if you look at the markets for a long time, prices, you feel that there are some points in time where you know that the market is going to move, tomorrow is going to be up. But tomorrow, no, for a year. So you get the intuition, the feeling that it can be predicted at some points in time. Now, but you have to test it. So what is our value? Our value is from that intuition. We take data, we crunch data, and we test. We see that, yes, it happens 10% of the time.
How could I have the trust that in your capability to have the sustainability of this know-how in the quality of the data, because it changes every day?
You mean the stability of the quality of the...
Yeah, because you have to adjust your data, your algorithm every day. So maybe today you're the better and you can show the best results for the minimum drawdown and so on, but tomorrow maybe not. Why are you recept the best one?
One of the advantages of a quantitative investment strategy is that it has like a path or a signature, a stamp. In terms of risk reward, it works in a certain way. It's not like it can work anyway. No, it has a risk profile. Let's call it a risk return profile. One of the things we do is We track that expected return, and we constantly monitor that the real return is in line with what should be expected. A very, very precise example. The long short strategy, the real performance, I use it for my portfolio, has had like a 3% drawdown. This is real during the last week. Not last week, a week ago. And suddenly it was 3% down. And it is absolutely in the typical statistics. The thing is that when it happens, everybody shakes. You don't shake, it's normal. It has to be expected. We know that 7 out of 10 months is going to be up. Three out of, this is one of the 3. Now, if at some point these risk return statistics start diverging from what should be expected, red light. Red light. So it's also a quantitative monitoring, okay, which is very important.
Yeah, because finance is not a scientific topic. It's a
human. It's a human.
And if Donald Trump is deciding new tariffs tomorrow, maybe your data have not the same quality, so you have to.
I don't think that the quality deteriorates. The thing is that there was a nice Sarah Townsend couldn't stop too much in some of the charts, like the media, this tool where we create synthetic time series, which we have demonstrated are better than Monte Carlo. Monte Carlo is the standard way to do simulations in the financial market. And one of the main reasons why they are better is because they are able to simulate volatility clustering. What is volatility clustering? The market doesn't have a stable volatility. Suddenly, because Trump says whatever, the market starts shaking. The dollar was up and then down, and everybody's shaking. What is going to happen? Those type of things are the things that we are able to simulate volatility clustering. Now, those times in the market, what they harm performance because of human behavior, uncertainty, fear. Nobody wants. Is there going to be a war or not? For a quant, we don't care. We will be stopped out of an existing position with a limited stop loss, which is statistically affordable, or we will be in the run because it finally goes in a certain direction. So the thing is, I was telling some of the attendees that a time that I love is when we go from designing a strategy, piloting it, but more manually still, to finally say it's over. The computer takes over. So I don't have to care. We only monitor results to make sure that the results are in line with what is expected. And suddenly, all the long positions are stopped out, stop losses, because of Trump saying whatever. What? And most of the times, you are stopped out, and the market goes in the right direction. And for young people, Beltran, my son said, Father, it's a pity because we were right in the algorithm, but Trump said this and we were stopped out. It's fine. We have to be stopped out, and we have to take it like it is. It is much better to be stopped out, take that loss, and bet again. Because it went up, but it could have gone down more, right? So that discipline is critical. Discipline. And it's very difficult to be disciplined in the markets. They are so emotional.
Mm-hmm. You said you depend on the quality of the data and the quality of the people, but you were a small firm in the huge asset management industry. To compare UBS, Goldman Sachs, and so on, they have more people, more engineers, more computer power. Maybe why do you have a chance to have the better result?
I don't think there are many big institutions that have a 30 people quant departments. We are all quants. We don't have secretaries. We don't have sales. We don't have sales. We don't have sales. We don't have nothing. We don't have anything. We only have quants. So how many banks? I don't think big tech, just to say a number, don't mention that, will have 30 quants in the company. No way. So we are a small company, but 100% of the resources are doing the same thing. And Banco Santander, they don't have a team like ours. BBVA, they don't have a team like us. I can guarantee they have. I have met the managing directors of wealth management fund manager, And they say, Jorge, we are way behind. We are nobody. Plus, they have another problem. They have this guy leaves to the other place and then to the place like butterflies. Sarah has been there for 20 years. So for 15 years. Jesus has been there for 17 years. Our managing director has been there for 15 years. I've been there for 38 years. Okay, thank God. So I think loyalty, it's a huge thing for quants, and it's a loyal team, and good, and it's a family business, and that makes it possible to make decisions which are very difficult in other places. That means stability. That means mission. Okay. And that's very important. And the other thing, we have a family office which is able to pilot all these strategies. So we are the guinea pig, and that generates a strong interest alignment. Every new strategy, I try it with my personal portfolio. I'm the first guinea pig. Then if it works, we like it, then we can show it.
At what level of development is the asset management in the quant investing? I mean, when do we see some ChatGPT instrument to invest? And
well, ChatGPT does a lot of things, but I use ChatGPT, but for other things. Like I said today, give me a good sentence about the beauty of that. Wow, it was great. It was it. I'm serious. It came from ChatGPT, so it is great for generating text, language, ideas, whatever. Yes, you can ask for an opinion about the stock and it will generate a report. And the risk is all these big guys around, you will suddenly read a paper and there's nobody behind. And this institution is relying on whatever is behind ChatGPT. It's not their own data, it's whatever. So they are really exposed to fake data. So I would never run my portfolio based on ChatGPT. But it can help me being more efficient in writing market commentary. It's going to do it much better than an analyst. It has more information. Then you have to underline, take this off, maybe fine tune it, but 90% is done. But managing a portfolio is a different stuff. And once you understand it very well when you look at the complexity of data, how complex, how sensible is to errors in the information that is reported. Okay, you know that when companies publish their financial reports, then they can correct. And in our database, we keep not only the published report, financial reports, but the day they are corrected. You have to take care of that. Okay, because people make decisions on errors, and then the company is able to make the corrections. So it's data.
But finance is very depending on incentives, and if there is only 3% in the quant investing, does it mean that the fees are too low, or the results too bad, or there is a reason? I'm
not sure we're talking about 3%, because quant is a very ample thing. It's a very wide thing. Right? I believe most institutions are using some type of quant. Maybe not systematic trading like us, like fully systematic, but I believe most of them are using quant to speed up processes, to speed up analysis. So is it quant or not? It is quant. Maybe it's not taken to the last moment where you replace human execution, but quant is everywhere. No institution, financial institution, big or small, will be able to survive without using math, using statistics, using whatever, call it AI or not, basic algorithms to analyze data.
But on the other side, you have to bring your products to the big banks to distribute this. Is it a reason why it's only 3-5%?
Well, one of the big barriers at ETS during the last years, the initial years, is that our only clients were financial institutions. So we had to convince financial institutions to use these apps. But now for several years, ETS is also a tool for final clients like family offices, which is easier. Why? Because we have our own family office. So whatever we do is we are not theoreticians, university professors. So whatever we do is to be used by our family office. Now, we want to share it with other family offices. So our preferred client is a family office. If there is an institution through which we can reach family office, then there is a deal. But the final client is typically a family office which has the sophistication, is able to understand the beauty of diversification. Family office, they all face the same problem, diversifying their investments. We're an additional investment, something complementary. We're not going to replace their passive positions or the real estate. We are going to add some value which diversifies the allocation. But our preferred target is family offices because we are a family office. Our business, our ETS belongs to our family office. Our family holding, okay, we have different companies. So ETS belongs to a family holding with a family office. Mm-hmm. So there is a strong interest alignment with other family offices. We have several family offices there today.
Where do you put your, where is your strategy of development, geographic, maybe in the US? You said that there
the US is a priority. Well, developed markets. Switzerland is a priority for sure. The UK is a priority. Mexico is a priority because we are, for historical reasons, it's a huge market, and there were several Mexicans here, and we have a partner there. In the United States, because there are 20,000 regulated investment advisors managing billions, and typically there are 3-4 people, ex-bankers, doing it like, ooh. So we believe we can add a lot of value to this 20,000 regulated investment advisors. Managing the smallest is 1 billion. So I think there's a lot of value. So those are our preferred markets. Plus, we are now in the process of launching a hedge fund in Ireland. This should be our flagship. What for? For all these strategies that we talk about and some others that we have time to share, they will be implemented in a multi-strategy fund there. Okay? So we will have a vehicle to show the power of a multi-strategy quant product.
Would it be a multi-asset product?
Multi-asset, yeah. Multi-asset, multi-strategy, but all listed instruments. Mm-hmm. So the long-short strategy will be there. Trading from the past will be there. A strategy that we have with options on stocks will be there. So different strategies that are uncorrelated, among them uncorrelated with the market. So a flagship fund, and then final clients. That could be family offices or family office through institutional partners.
Mm-hmm. So the result of this type of product, uncorrelated assets, is it bringing better results in terms of risk adjustment returns than diversification products?
Yeah, generating alpha under different market scenarios, even a crash. That is the idea, being able to generate alpha under different market scenarios. And this is more a personal belief about as an investor, I mean, being able to decorrelate with the markets, with a big part of our portfolio. So I think a lot of family offices will have more money in their private equity, real estate, and exposure to markets because of all this huge uncertainty and growing will diminish. So if you are exposed to the market, it should be through some things that are more sophisticated, that we can extract alpha without being exposed to the next crash. I don't want to be in the next crash. And we all know the next crash is going to come. I don't know if this year, this month, tomorrow, but we know the world, what is happening in the world. It's a very complex world. Okay? We talk about macro, I mean, it's like a bomb. If we talk about geopolitics, it's a double bomb. So the world is shaking, and the market and the money really flies away when there is uncertainty.
You talk about hedge fund, but not on UCITS products. Is not plans in the long term?
Well, it's going to be a listed fund, but it's going to be an alternative fund inside an umbrella. So my vision is one: we will create a multi-strategy, but at some point, we will split into different funds. So you, as a final investor, can select the asset allocation between the strategies. But in the beginning, it will be a single multi-strategy fund.
Okay, thank you very much.
Manuel, thanks a lot. Thank you for your time, for coming.